If you've ever wondered if it's actually possible to build a portfolio that replaces your income through dividends, this is the video for you. I ran 4 10-year simulations and the results show just how powerful consistent investing, compounding, and reinvestment can be. You don't need millions. You don't need to time the market. You just need the right approach and some patience. If you want to reframe how you think about wealth, retirement, and freedom, we're getting into that today. So let's go. Welcome back, everyone. Rico here. Most people are taught one retirement strategy. Buy growth stocks, hold them, and then when you retire, start living off of 4% of your portfolio. Whether that's from selling stock, collecting interest, or a mix of the two, comment down below if this is the advice you've gotten from your friends and family, or even your financial advisor. So that 4% rule, it can work, but it also means slowly depleting your accounts and your investments. That can create fear, especially in volatile markets like the ones we've had recently. And that fear of running out of money, it's real. And my parents, they're a really good example of this. When the Great Recession rolled around in 2007, 2008, they lost around 40% of their 401k in a matter of months. And my parents were lucky because my dad, he has a pension from working for the government, and my mom has extended healthcare benefits since she was a nurse her whole life. But if they didn't have those things, their lifestyle would have had to change for sure. And this just goes to show that market downturns and inflation, it can hit people's portfolios hard. Now, what if I told you there was another way? What if your investments could pay you every single month without ever needing to sell a share? Even if there's a downturn, your income could stay consistent. And that's the idea behind the income-based approach that I want to walk you through today. You can build it fast, you can build it slow, and you can tailor it to your goals and your specific timeline. And just so we're clear, as always, this isn't investing advice. This is for educational and entertainment purposes only. Always, always, always do your own research and make decisions that fit your situation and your goals. We're all different ages. We're all in different stages of life. 5, 10, 20, 40 years could be the difference. And that being said, I want to share this one thought before we dive in. This is how people create wealth and freedom. Freedom to live life on their terms. Whether that means early retirement, working part-time, enjoying time with loved ones, or simply just having more options at hand. Okay, so before we get into the strategy, I want to go over the metrics we're using to compare each of these scenarios, just so we're all aligned, okay? So the first one is going to be ending balance. This is the total portfolio value after 10 years, and it'll include contributions, reinvested dividends, and any price appreciation. And the next is annual income. This is what you'd earn in dividends or distributions in year 11. So if you didn't add another dollar, this is what you would get in year 11. And then third is total dividends. This is the total cash distributions you would have received over the 10 years. And then finally, yield on cost. This is your annual income divided by how much you personally invested. It shows how much income your original dollars are now generating year over year. So let's break down the examples, starting with the most traditional. We're going to start with VGT, the Vanguard Information Technology ETF. It's one of the most popular growth plays. It's filled with tech giants like Apple, Microsoft, Nvidia, Netflix. It's stable, it's reliable, and it's what many financial advisors recommend for long-term wealth building. I have a good amount of this stock in my own 401k. Since I can't access those funds for another 20 years or so, that 401k is just focused on growth. So I hold things like VGT, VUG, and VOO. Okay, so I modeled a scenario where you start with a lump sum investment of $50,000, and it's at its current stock price as of the day of this recording, which is $691.85. And the current distribution yield for VGT as of today is 0.46%. And by the way, I used marketbeat.com's free dividend calculator for all of this. They're not a sponsor. It's just a tool I like using for running scenarios and projections like this. Here are the parameters for this scenario. DRIP is on, or dividend reinvestment, that's turned on. 7% annual growth in both share price and dividends. $5,000 additional contributions per year, which this is a typical scenario for someone wanting to save for retirement. I think your Roth limit is like $7,500, so $5,000 is conservative. And then we did it in a 10-year time frame, so we can see how much longer or how quickly these scenarios need to be for you to reach your particular goals. So for you, it might be 10, might be 2030. So here are the end results for that scenario for VGT. So the ending balance, $172,897. Total dividends paid was $4,513, $797 in annual income, and then a yield on cost of 0.76%. So solid growth, but definitely not built for income. After that $50K lump sum and another $50K over 10 years plus drip, you're getting under $800 a year. That's about $66 a month. Definitely not something you can retire on, but you might be able to sell shares to live off of if that's your choice. Next, we're going to go into Realty Income, ticker symbol O. This is a real estate investment trust, or a REIT, that owns retail and commercial spaces across the country. And it's famous for increasing their annual dividend for 30 straight years. That included at least 3 huge recessions if you look back. And the current stock price is $56.95 with a current distribution yield of 5.62%. So we're going to run it through the same exact scenario, $50,000 lump sum with $5,000 per year over 10 years. Drip is on. And then for this stock, I assumed only a 1% annual growth in share price and dividends. And this is pretty conservative as compared to what they've done in the past, but I wanted to keep it that way for illustration purposes. Remember, I set VGT to 7% growth year over year, and this is set to only 1%. And let's get into the results here. So the ending balance is $164,559, so less than VGT's, but only by around $800. Total dividends paid, $55,000. And this is more than 10 times what VGT would have paid. And then the annual income is more larger too, $9,490. This is also 10 times what VGT would have given you per year in just distributions. And here, much bigger yield on cost, again, 10 times greater, 9.07% yield on cost. So this amounts to around $790 a month in income from a rock solid company. And again, that's based on a super modest growth, and Realty Income has been around forever, and it's increased dividends for 30 straight years. So that's definitely something to consider. All right, next is QQQI, which is a modern covered call ETF that earns income by selling options on the NASDAQ 100. This is designed to maximize cash flow. You're going to see, even if you give up a little bit of upside. Also of note, QQQI won ETF.com's 2025 ETF of the year, and it's growing in popularity with a lot of income investors for sure, especially this one, because this is one of my favorites. And as of this recording, the stock price is $52.90, and its current distribution yield is 14.19%. And you might already be able to tell that this is probably much different than VGT, and the numbers will bear out that scenario. Okay, so same numbers, $50,000 lump sum with another $5,000 per month over 10 years. Drip is on. And then for this ETF, I assumed 0% growth in both share price and dividends. It's definitely grown since its launch last year, but for illustration purposes and for those that say growth is unrealistic, let's keep it flat across. People will say NAV erosion, return on capital, whatever, just keep it at 0. So here are the results. The ending balance was $307,163. That's almost double VGT and Realty Income. The total dividends paid are $207,173. So crazy. This is 4 times Realty Income and 50 times VGT. And the annual income is $46,536, which is again 4 times greater than Realty Income and 50 times higher than VGT. And then the yield on cost, much better here, 41.85%. So looking at this scenario, that's nearly $4,000 a month in income. And again, this is assuming no growth at all, just compounding the yield. And so remember that this is a 10-year timeline. So looking at these results, depending on where you are in life and what your goals are, choosing from one of these 3 paths could be your best option. Only you can really decide if something like VGT, Realty Income, or QQQI fits your timeline best. And now, this one is a bit crazy, but this is the outlier, ULTY. This is the Yield Max Ultra Option Income ETF. And this is an aggressive, weekly paying, covered call strategy with higher yield, higher risk, and it's definitely not for everyone. But I did want to run the numbers just for education. This is an experiment, and this will look so cray-cray, but let's just see how it turned out. So for this model, I went extremely conservative. So it was only a $1,000 initial investment with no additional contributions over the 10-year scenario. Drip is on, just like everything else. And then for this ETF, it can be perceived as more volatile. So I baked in 10% annual decline in both share price and dividends. And this was the only one that I had negative growth. And this is try to account for people's thoughts and fears on NAV erosion, return of capital, etc. So let's run it. The current share price as of recording is $6.02 with a distribution yield of 194.94%. And remember, this is with an annual decline starting with just $1,000 lump sum investment. This is going to be crazy, but here we go. Here are the results. The ending balance, $114.5 million. million. Crazy. Total dividends paid, 119 million. And then an annual income of 264 million. Like, this is so crazy. It's even hard for me to read this, and even for marketbeat.com to show the numbers. It was just insane to see this report. And again, this is not a recommendation, but it shows how even with declining assumptions, high yield drip can compound aggressively. This is a great lesson and illustration of exponential growth. And I know there are a lot of naysayers in the investing world when it comes to covered call ETFs and the strategies that firms like Neos, YieldMax, Roundhill, BrexShares, others use. But you have to take into account total return and not simply look at the share price growth or NAV erosion. Those are great indicators, but definitely not the be all end all. And also keep in mind, most people likely won't stay in it for 10 years or reinvest everything back into this one position like ULTY. But it's hard to deny the income and how you could use this to build other positions. Just food for thought, putting it out there. I own ULTY and I use a lot of that income to live off of, but also to build other positions. So just to sum it up, let's look at the numbers side by side. It's going to look crazy, but let's just do it. VGT, it's a good option for strictly growth, but even at 7% appreciation every year, QQQI still outperforms it with more conservative numbers. It is higher across the board, and it can show you how you can replace your salary perhaps sooner than maybe you thought before. So again, check out the numbers, VGT's ending balance, looking at QQQI. These numbers are just insane. Realty income, if you're not into the covered call, is a good play if you want to get into income investing, because you can look at the returns. It's not bad. And you can look at the annual income. It's not bad. If you did this for, 20, 30 years, then these numbers will obviously get much bigger and your annual income will be much bigger. ULTY, still, to me, it's insane that $1,000 investment can turn into millions and millions of dollars, but it's just an illustration. Again, what these examples show us is that you definitely have options. You can build a portfolio that not only grows, but pays you every month. You can build the security you want, the flexibility you want, and ultimately the freedom that you want without necessarily having to sell off your life savings or sell all your shares. And the earlier you start, the more powerful the snowball becomes. So you can even use a mix of these things. That's what I do. Now, if this changed how you think about investing or even sparked a little curiosity, I would love it if you could do me a favor, like this video, subscribe if you haven't already, and leave a comment with the next ETF or REIT you'd like me to break down. Thank you for watching. If it doesn't challenge you, it doesn't change you. Messy action is better than no action. Take care, and I'll see you next time.